Hello and welcome to this video. Today we'll be talking about the balance sheet. The balance sheet shows the financial position of an entity at a certain point in time, which is usually the end of the financial year ending 30 June, at least in Australia. For those who don't know, the accounting formula is A equals L plus E, meaning assets equals liabilities add equity, which make up the three sections of the balance sheet. The order of assets, liabilities, and equity can be different. However, it is most common to find them in that order, as seen here. Let's start with the assets. Per Statement of Accounting Concepts 4, an asset are future economic benefits controlled by the entity as a result of past transactions or other past events. Statement of Accounting Concepts 4 defines liabilities as the future sacrifices of economic benefits that the entity is presently obliged to make to other entities as a result of past transactions. So basically, whether or not it is a good or a bad thing for the entity. Assets and liabilities are further categorized into current and non-current. For simplicity's sake, it is current if an item can be realized in under 12 months, but non-current if more than 12 months. Therefore, short-term loans, stock, cash, debtors, and creditors are all seen as current, as their benefits can be quickly incurred within a 12-month period. However, property, plant, and equipment, and mortgages or hire purchase liabilities are non-current. Another peculiar item is goodwill, which is non-current due to its nature being an intangible asset since it is not physical. And make sure to keep an eye out for a goodwill video in the near future. Now we'll come to the net assets, which is calculated as total assets less total liabilities. And if this number is negative, it's a concerning sign for the entity, meaning they have no capacity to pay their current debts. However, if it is positive, they can, so therefore they are in a decent position. It is important to note that there are usually items that are usually not in the balance sheet for small and medium-sized businesses, which should be included to show the quote-unquote true and fair representation of the fair market value of the net assets employed in running the business. These items include, but are not limited to, incorrect debtors and creditors balances, annual leave and long service leave, noting that this is first realized by the entity when an employee hits 7 years of service, but are not legally required to pay it out if the employee leaves before 7 years of service, meaning if they work for 6 years and 11 months and quit, they receive no long service leave benefit, and therefore this doesn't carry over for the business. Lastly, we have the equity section of the balance sheet, which contains a line item named retained earnings for a company or trust. Some balance sheets will also have a line with current year profit, but this is usually aggregated with retained earnings. The other line items you'll see will be settlement sum for a trust or share capital for a company, which shows the number of shares or units which are held in the entity. In a partnership, the equity section will be a little bit different. You can also check that the net assets should be equal to the total equity. And that is it for this video. If you enjoyed this video and want to see more, please remember to leave a like and subscribe. Thanks for watching.